Hi, I'm Paul Mowbray, President of Mowbray Wright Financial Investment Planning Council. In this video, I will review with you the details of flow-through shares and the huge tax benefits available. A flow-through share is basically a common share with added tax benefits, but more restrictions. It's a special type of common share that is issued exclusively by oil and gas or mineral companies. They allow investors to claim federal and provincial tax deductions. Flow-through shares are supported by the federal government to increase investment in these industries to encourage exploration and development in the resource sector. Junior resource corporations tend to have difficulty raising capital to finance their new exploration activities. The flow-through share is in place to allow issuer corporations to transfer the resource expenses through to the investor. This flow-through of tax deductions has been hard-coded on our Canadian tax return since 1952. You won't get any arguments from the CRA. The tax deductibility of flow-throughs is not assailable. The tax deduction will be to the penny as proposed. Well, you can purchase flow-through shares directly from the company that issues them, or you can purchase them from an investment firm or financial planner. They can be in the form of single company shares, limited partnerships, pools, or mutual funds. By purchasing flow-through shares in a pool or mutual fund, you have the opportunity to purchase a diversified portfolio of flow-through shares. Flow-throughs issued by more than one company with professional management, and this will decrease the potential risk and volatility. Well, there's two ways that you can make money on flow-through shares. The first is an increase in the price of the shares. Just like regular common shares, the market value of the share can increase or decrease. The second is tax deductions. Your return you get from your flow-through shares varies slightly depending on what tax bracket you're in and what province you're living in. As an example, if you invested $10,000 in flow-through shares, you could deduct the entire $10,000, 100% on your tax return. If you're in a 40% tax bracket, that would equate to a $4,000 tax refund in that year. Some flow-throughs allow even 125% tax deduction. That sounds pretty good, doesn't it? 125% tax deduction. I'm sure you're wondering, if there are such great tax benefits on flow-throughs, why doesn't everybody purchase them? There's typically increased risk of purchasing flow-through shares compared to a typical blue chip stock. Even so, flow-throughs are the most popular investment for tax-conscious, high net worth investors after they maximize their RSPs. Three main risks of flow-through shares. They are typically offered by smaller companies, and this is especially risky in this sector as the companies are often still in the exploration stage and not yet making a profit. 2, investing in mining or oil exploration is a speculative investment. No guarantee that they will find what they are looking for or the amount they expect to find. It could be very profitable or could not pay off at all. 3, flow-through shares have a holding period of 18 months to 2 years. During this period, your money is illiquid. No matter how good or bad the company is doing, or for any reason you may need the money, your investment will be illiquid for 2 years. The only non-risk is the tax deduction. It will be exact, to the penny, what it is presented to be. Now that you know the risks, you may be wondering, if you want to get rid of them, how do you sell them after the 18 to 24 month holding period? You can sell flow-through shares using the same method as you would to sell regular common shares or mutual funds. However, you normally have to hold on to the shares for 18 to 24 months. It is possible that the cash out for you could be prior to the 24 months, but only if the promoter or general partner sells the entire flow-through portfolio early. They may do this if the portfolio is performing better than expected. When you sell your shares, the adjusted cost base is set to 0. This means that the entire sale proceeds becomes taxable capital gain. So, going back to the $10,000 example, if you were to have sold that investment 2 years after for $10,000, i.e. no gain on the share price, your capital gain would be considered to be $10,000, even though the value of the share price did not actually increase. This would make your taxable capital gain half of that, or $5,000, leading to a $2,000 tax bill, assuming a 40% tax bracket. You're still ahead $2,000 in profit overall because you had the $4,000 tax refund in year one minus $2,000 tax payable. Profit could be higher if the share price has increased in value. The costs are similar to the costs associated with other common shares, paying the purchase or sales commission. There is no additional ongoing charge or fee or trailer fee or MER for owning most flow-throughs. The commission is typically built into the cost and therefore adds to the tax deduction, and some flow-throughs have no upfront commission, just a performance bonus on the sale if the investment does well. Flow-through shares are not for everyone. If you think it's possible you may need to withdraw your funds prior to the 18 to 24 month period, flow-through shares would not be a good option. If you will not need access to your funds in the next few years and are in a high tax bracket looking for ways to lower tax, flow-through shares may be worth looking at. Perhaps dip your toe into the flow-through waters the first go-around. I hope this video has shown you the benefits of flow-through shares and how they may work for you. If you need additional assistance, please contact me. I'm Paul Mowbray, and I'll see you on the next video.